Good morning, traders. Here's your market update for today. The US dollar index has continued its upward trend, reaching a near 4-month high as of Monday. The dollar's strength is largely supported by the Federal Reserve Chair Jerome Powell's hawkish stance on the interest rates. The market expectations for a December rate cut have cooled significantly, giving the dollar further momentum as it's making its best monthly performance since July. With some US officials, including the Treasury Secretary Bessent, having expressed concerns that high interest rates are pushing parts of the economy, especially housing, towards a recession, the Fed's commitment to its independent, data-driven approach continues to underpin market confidence. As long as the economic data remains strong, the dollar is likely to stay supported. Technically, the dollar index has broken above a key resistance level and remains in short-term bullish trend. Strong treasury yields and a wide interest rate differential with other major economies continue to favour the dollar, though resistance around the psychological 100 mark could test the strength of this momentum on the upward trend. So now turning to the oil markets. With WTI crude traded slightly below $61 a barrel on Monday, supported by ongoing uncertainty surrounding Venezuela. Although OPEC agreed to increase production in December, the planned rise is modest and will be paused in the first quarter of next year, less than what the markets had anticipated. The geopolitical situation, particularly in Venezuela, has added volatility and uncertainty to the oil markets. At the same time, a stronger US dollar makes oil more expensive for buyers using other currencies, which can also dampen global demand. Despite these headwinds, oil prices have shown resilience, rebounding above that late October low of around $56 a barrel. WTI has held above key moving averages and even forming a bullish technical pattern. If the prices stay above the $61 mark, then they could push further higher even towards the next psychological level of $62. Overall, oil remains supported by a mix of geopolitical factors and technical strength, even as concerns about oversupply continue to linger. Spot gold traded around $4,000 per ounce on Monday after falling earlier to just below $3,963. Hawkish signals from the Federal Reserve and easing trade tensions have both pressured gold prices recently. Despite this, gold rose nearly 4% in October, marking its third straight monthly gain. So this is supported by ongoing geopolitical risks and concerns about the potential US government shutdown. So higher treasury yields have reduced the appeal of gold as a non-yielding asset, especially since the yield on the 10-year US Treasury note has posted its biggest weekly gain since April. From a technical perspective, gold has been trading sideways after testing highs near the $4,380 mark, suggesting that bullish momentum is weakening. If gold fails to break above key resistance levels near the 4,030 mark to the 4,050 mark, prices may retrace towards the $3,900 area. Conversely, a decisive move above the 4,050 mark could open the door to a mark of about $4,100. The metal's short-term direction will largely be dependent on how interest rates and interest rate expectations are evolving in the coming weeks. Finally, let's look at the Australian dollar. The Aussie dollar traded around the 65.40 mark on Monday, slightly weaker than the US dollar, as the US dollar continued to strengthen. Market sentiment suggests that the Aussie may face further pressure in the near term as expectations for a Federal Reserve rate cut diminish. Investors are now focused on the Reserve Bank of Australia's upcoming policy meeting. The RBA is expected to keep rates unchanged after 3 cuts earlier this year. Recent inflation data came in stronger than expected, which has reduced the likelihood of any further easing. Australia's annual inflation rose to 3.2% in the third quarter, signalling that the central bank may take a wait-and-see approach. Technically, the Aussie-US pair is consolidating between the 65 and 66 mark. The RSI indicator suggests that there is still some room for upward movement, while key support remains around the 65 and resistance at the 66 level. The pair's next direction will likely depend on both the US dollar strength and how the RBA frames its outlook for inflation and growth in the coming weeks. In summary, global markets remain highly sensitive to signals from the Federal Reserve and to shifts in global supply and demand dynamics. The dollar's strength, oil's weakness, gold's volatility, and the Australian dollar's fluctuations all reflect a world that's still adjusting and evolving to monetary policies and geopolitical realities. Trade safe, and I'll see you in the next update.